Hello everyone, this is Sunko, the Korean bro. Today is 2024, January 16th, and let's see what articles we have tonight. Okay, let's see. Top two dividend stocks you can buy and hold forever. Colgate, Palmolive, and like Emerson Electric. Hmm. We got two brands here. None of them are my interest. Uh, Three incredible growth stocks that could soar in 2024, according to Wall Street. Pre-revenue innovation companies have been in a two-year slump thanks to rising interest rates. With the Federal Reserve poised to start cutting rates later this year, this equity group could be gearing up for a rally. Wall Street is expecting big things from these three cutting-edge healthcare stocks in 2024. Beam Therapeutics, Edgewise Therapeutics, Monte Rosa Therapeutics. They're all therapeutics company. Okay. Vanguard funds here. Small cap value. Hmm. If you invest $350,000 in the Magnificent Seven stocks, here's how much you could earn in dividends. That the S&P 500 index higher last year. These tech giants aren't known for paying dividends, but they are collectively returning a staggering amount of money to shareholders. Investors might want to own the Magnificent Seven stocks going forward. Hmm. But it's not all about blockbuster gains because some of the Magnificent Seven stocks also pay dividends. I'm going to show you how much you could earn with a $350,000 investment split equally across seven stocks. As I touched on, the top investors who didn't own the Magnificent Seven stocks in 2023 likely underperformed the S&P 500 index. The law of large numbers makes it somewhat counterintuitive to expect these enormous companies to continue delivering the best returns in the entire market. So uh because it gets harder for them to grow their revenue and earnings each year. However, it so happens that the Magnificent Seven companies operate at the forefront of the fastest growing industry in the world. For any investor seeking exposure to technologies like AI, cloud computing, e-commerce, digital advertising, electric vehicles, uh, it's nearly impossible to look past these stocks. Depending on which Wall Street forecast you rely on, AI alone could add between $7 trillion and $200 trillion to the global economy in the coming decade. Each of the Mason 7 already has a foothold in the industry. They will likely deploy their considerable financial resources to ensure they capture a large slice of the opportunity. Therefore, the Magnificent Seven will likely be a great place for investors to park their money for the long term. Any individuals earned are an added bonus. Altria Group, British American Tobacco. Hmm. Okay, here we have Google. Okay, investors have flocked to high-profile stock split stocks for more than 2 years. Since the midpoint of 2021, nine high-flying companies have conducted four stock splits, including semiconductor stock Nvidia, internet search behemoth Alphabet, and e-commerce kingpin Amazon, which effected respected splits of 4 for 1, 20 for 1, and 20 for 1. Although the act of splitting the respective shares is a very short-term catalyst driven by investor emotions, for stock splits, more importantly, act as a beacon for businesses that are out executing and are out innovating their competition. For example, NVIDIA has gone on to become the infrastructure backbone of the artificial intelligence revolution since conducting split in July 2021. The company's 800 and 800 AI-inspired graphics processing units may account for a greater than 90% share of GPUs in used by high compute data centers this year. While NVIDIA stock would probably be soaring with or without its stock split in July 2021, its previous split has made shares more affordable for investors without access to fractional share purchases. Stock splits have also served as a reminder of just how impressive Alphabet's and Amazon's respective moats are. Alphabet's Google tailed nearly 92% share of global internet search in December, which is 88 percentage points higher than its next closest competitor. Google Cloud has also gobbled up a 10% share of worldwide cloud infrastructure service spending. Meanwhile, Amazon brought in approximately 40% of US online retail sales in 2022 per insider intelligence, and is the leading provider of global cloud infrastructure services via Amazon Web Services. AWS sports an annual sales run rate of $92 billion and is currently responsible for a lion's share of Amazon's operating income. Long story short, it's very easy to see why investors have flocked to high profile stock split stocks in recent years. Just keep in mind that not all stock split stocks are worth investing in. Okay, along with that, I want to read this article because not only Amazon and Google has gone through stock splits, but also Shopify has done a lot of stock split in the past. And for as far as I know, they are planning to have another stock split this year, or like from what I know, they did it at the end of last quarter. So let's see if they really did it or not. Okay, the business has drastically improved after spinning off its logistics division. Shopify's operating margin hit a recent high this quarter. Stock may be pricey, but the accomplished quality makes up for it. Hmm. Okay. Amazon operates a diversified business model with a variety of revenue streams. It could still grow its e-commerce business locally and in overseas markets. Meanwhile, it has great potential in other areas such as cloud computing and AI. The next Amazon is still Amazon. So investors are always looking for a next big idea that could become the next Amazon. While this innovator could be rewarding, assuming we can find the right company, it is tough to do because each successful company is unique. So these future leaders will likely emerge from the most unexpected places. An easier way is to bet on the existing winner to keep winning over the long term. Yes, investors can consider Amazon itself rather than the next Amazon as a diversified income stream. Amazon has been one of the greatest success stories of the last 2 decades. It started a small online bookstore, but went on to dominate the e-commerce industry by selling almost everything on its flagship platform. It continuously added new product categories and services to delight its customers. It even invited the competitors by setting up Amazon Marketplace, allowing third-party sellers to sell on its platform. This move significantly expanded the product selection, giving customers good reasons to return for more. Amazon Prime is another example of the company's ability to introduce new services to delight its customers, enhance customer loyalty, and ultimately sustain its ecosystem's growth. As Amazon grew its retail business, it quietly launched its cloud computing business, Amazon Web Services, to expand into the commercial sector. As the first mover, AWS quickly became the preferred service provider for companies to leverage cloud computing for expansion. As these customers scaled their business, AWS was well positioned to grow with them. Cloud computing business, Amazon Web Services, to expand to the commercial sector. As the full As the first mover, AWS quickly became the preferred service provider for companies to leverage cloud computing for expansion. As these customers scaled their business, AWS was well positioned to grow with them. Amazon's relentless focus on innovation and experimentation over decades led to a diversified and robust business model that offers stability and opportunity. So, out of the $143 billion revenue in the third quarter of 2023, 44% came from Amazon's first party sales, 24% from a third party seller, fees, 16% from AWS, and 7% from a subscription fees. From advertising services and remaining from other services. With so many revenue streams, Amazon can weather temporary challenges associated with economic downturns, industry specific challenges, or geopolitical uncertainties. If one segment faces difficulties, the remaining segments can cushion the shock, reducing the overall volatility in the company's financial performance. Better still, such a business model offers ample opportunity for Amazon to reinvest for future growth. The elephant can still dance. Amazon has been one of the most successful growth stocks over the last 2 decades, growing revenue from just $511,000 in 1995 to $514 billion in 2022. While Amazon's already gigantic size means it is unlikely to grow at its historical rate, it still has a good growth prospect in the coming years. The e-commerce, for example, while Amazon is the clear leader in the US with around 38% of the e-commerce market share, its overall retail share and remains low because e-commerce penetration is just about 15% of total retail sales. Beyond that, Amazon can grow in emerging markets like India. Similarly, the emerging markets like India. Similarly, the cloud computing industry has promising growth prospects thanks to the ongoing migration to the cloud and the rapid development of artificial intelligence technologies. AWS's leading market share positions the company well to capitalize on any pent-up demand for existing storage and computing services while launching new features and products as the new technologies emerge. Another critical factor investors should not note is that Amazon's culture of experimenting with new ideas, products, and service innovations, as well as its focus on customer delight, provides the right platform for the company to sustain its growth momentum. With such a culture in place, the tech company is set to keep up with the latest trends, giving it access to future growth opportunities. I'll say I think the tech giant can still grow for a while, betting on the winner. Amazon has been one of the biggest wealth generation machines for over 2 decades. It first dominated the e-commerce sector and later became a leader in other areas such as cloud computing. To invest in Amazon for the next 5 years is to bet on the company's ability to sustain its leadership in e-commerce while expanding in other areas like cloud computing and AI. I think it has a good chance of achieving that. Okay. Investing early and often can be an effective way to set yourself up for a great retirement. Investing early and often can be an effective way. So here it is. Living off dividend income can be a great goal to strive for in retirement. Expenses are often lower during your retirement years, and generating $50,000 in annual dividends can help you live comfortably. And while that is not a small amount of dividend income, generating that much in the future may not be as daunting of a challenge as it appears to be. Just look at how investing $50 per week can help fund your retirement years. Investing in growth is the best option to build up your portfolio. Dividend stocks can be safe options for investors on a fixed income who need stability. But if you're looking at an investing period to span decades, then growth stocks can be a much better option for you. That's because while there might be volatility and bad years along the way, it should balance out over the long term. A great example is the performance of the Invesco QQQ Trust, which gives investors exposure to the top 100 non-financial stocks on the Nasdaq stock market. The tech-heavy fund includes a big names such as Apple, Microsoft, and Amazon. Over the past 10 years, its total returns have totaled 407%. That averages out to a compounded annual growth rate of 17.6%, well above the long-run average of the S&P 500, which is close to 10%. The fund is a good place to invest, especially if you're unsure of which stock to put your money into. You can simplify your investing uh, strategy, making it easier to set aside money every week into the fund. So, getting your portfolio to $1 million is the key. Before you can rely on dividend income, you first need a fairly large portfolio balance. And you can build it up over the years by investing just $50 per week. So, this chart shows you how, over a period of 30 years, investing $50 every week could grow your portfolio to more than $1 million. 1.5 million dollars. Hmm. Okay. So, assuming a 15% annual growth rate of $50 per week investment could grow to a value of more than $1.5 million after 30 years. It would take a little more than 27 years for it to hit the $1 million mark. Averaging such a high growth rate may be challenging, but even if it's not quite that high, you could still end up close to over $1 million. And with a growth focused fund such as the Invesco QQQ Trust, you can maximize your odds of achieving those kinds of returns without having to take on much risk in the process. So if you get your portfolio to $1 million or more, you've accomplished the hard part. Once you got a balance that high, you can put it to work by investing into high yielding dividend stocks. During your retirement years, you will likely want to move away from growth stocks anyway and to less volatile investment. And the higher that balance gets, the less of dividend yield. You'll need to generate some significant income, right? If, for example, your portfolio gets to a value of $1.5 million, you could invest in a fund or multiple investment that yield an average of 3.3%. At that rate, you could then in annual dividends with a lower portfolio balance of $1 million, you would need to target an average of yield of 5%. Invest early and often for the best results. Amid inflation, rising interest rate, it's not easy time to find money to invest in stocks. But if you can find a way to cut $50 per week out of your budget to invest into a diversified fund such as Invest with QQQ Trust, you can pay off in droves for a year later in life. Okay, we got advanced micro devices and Micron. Hmm. Let's read a bit of this article. Okay, it's mostly all my money is into seven companies, but then you know um it's good to know what companies are doing good, right? Because I can catch up with the latest trend um, by getting to know what they're up to. Uh, I could possibly find rising company, that could lead to you know um increase of my asset, right? Advanced micro devices. AMD is one of the most important chip companies in the world. Its hardware is prevalent in some of the most popular consumer electronics, including the Microsoft Xbox, Sony PlayStation 5, and AMD chips powered the infotainment system in Tesla's electric vehicles. So pretty much AMD hardware is everywhere. It's used by the biggest companies in the world at this point. AMD also has a data center segment where it sells chips to cloud providers. But last year it took an enormous leap forward by announcing its new M1 300 lineup. Its MI300 Axis stand-alone graphics processing unit designed to compete with NVIDIA's leading H100. In contrast, it's a combined GPU and central processing unit hardware to create the world's first accelerating processing unit for data centers. Uh, Micron is a chip maker like AMD, but it makes very different hardware. Micron is a world leader in memory and storage chips, which aren't glamorous as a GPU sold by AMD and Nvidia, but are equally important to edge devices and the data center. Okay, it's not as important as GPU, but it's still uh it is important. Okay. We got Datadog here. Quarterly revenue. Let's see. Artificial intelligence. Mm. Provides observability and cybersecurity software for development, operations, and security teams. Its platform includes dozens of products that aggregate, analyze machine data from application and infrastructure, helping business identify and resolve performance issues and security threats across their IT ecosystems. The Datadog platform also leans on AI to automate incident investigation and remediation. Datadog has received praise from several industry experts. Consulting has gotten a huge company as a leader in application performance monitoring, doing part its broad product portfolio. Similar Forest Research has sees the company as a leader in AI for IT operations because its platform offers unparalleled data insights and visualizations. Uh, hmm. Okay, here we have it. The third supercharged growth side that can plunge in 2024 based on the prognostication of one Wall Street analyst is electric vehicle manufacturer Tesla. Longtime Tesla bear Gordon Johnson of GLJ Research has a $24.33 price target on North America's leading EV maker, which would translate into 89% downside based on where shares closed on January 12th. There's no question that Tesla has ridden its first mover advantage in the EV space to phenomenal gains. The company achieved its target of producing 1.8 million EVs in 2023. And it recently launched its fifth mass production model, the Cybertruck. According to CEO Elon Musk, Tesla took in more than 1 million refundable $100 deposits to reserve a Cybertruck. Unlike other pure play EV manufacturers, Tesla is profitable. It likely registered its fourth consecutive year of GAAP profits in 2023. Tesla stock has exploded higher because it's demonstrated that its operating model can be profitable on a sustained basis. So, but there are reasons for current and prospective shareholders to be concerned. To begin with, Tesla kicked off a price war with other EV manufacturers last year, resulting in over half dozen price cuts for its production models. During Tesla's annual shareholder meeting in May, Musk made clear that his company's pricing strategy is based on demand. A steady stream of price reductions suggests that demand is weak, inventory levels are rising. Not coincidentally, Tesla's operating margin has collapsed from 17.2% to 7.6% over a trailing 12-month period. So there's also a growing list of unfulfilled promises from Tesla's chief. For instance, Musk has been suggesting that level 5 full self-driving is 1 year away for a decade. A sizable percentage of Tesla's market cap is based on Musk's vision becoming reality. Unfortunately, many of these expectations have failed to materialize and could eventually be backed out of Tesla's valuation. That leads to the logical final point Tesla's valuation. Although Tesla has tried mightily to become more than an auto stock, it still generates the overwhelming majority of its profit from selling and leasing EVs. Breaking this down even further, 31% of its third quarter pre-tax profit can be traced to unsustained sources. While auto stocks typically trade at a multiple of 6 to 8 times 4-year earnings, Tesla is communicating a 4-year multiple of 58. Drew Johnson downside target for Tesla may be a bit extreme. My own prediction is for Tesla to dip below $100 in 2024. Palantir and Upstart Holdings. Okay. Palantir and Upstart Holdings. Okay, anyway, this is it today, and I'm gonna see you tomorrow. Okay, see you and have a good night, everybody. Bye bye.